Hello, I'm Jules Kelley and I'm the Sales and Marketing Manager at the Smats Group of Companies, and today we're joined by Steve Douglas, the Executive Chair of Smats Group. We recently shot a webinar series around the Australian repatriation tax planning, and we've been sent a whole bunch of questions. Fantastic. Which we're going to answer today. So let's kick off. The first question is, what tips do you have for attorneys with foreign assets such as overseas property?
Well, the key on there's two things. Probably number one is obviously the tax implications, and the main thing around that is assessing if a valuation is required. And certainly if it's a property, it needs a valuation. It needs to be by a sworn valuer at the time of returning to Australia. The other issue is obviously retention. A lot of people are unsure whether they should keep or sell the asset. What I often will say to people is evaluate, obviously, if you want to personally keep the asset, but also consider if you would buy it again at today's price, because that's the easiest way to determine if you've got confidence in the value in the future, whether you think it'll appreciate. And you also need to assess whether you need the money for other things. So combination of those three elements, you want to consider, and again, we can assist you with that as required. When's
the optimal time to make decisions around your overseas assets?
Well, you certainly want to be considering all these things as early as possible. The Australian tax system is very complicated. We do have global tax, so you need to know what the impact of any of your assets is going to be as early as possible, so you can decide whether you do want to keep it. A lot of assets aren't easy to sell, so you might need a lot of time. So again, early preparation, early consideration is essential.
Do you need to sell your overseas property before returning to Australia?
Yeah, there's certainly no need to sell, and it's one of the misconceptions. A lot of people think that you need to sell because it's going to become a taxable asset. But in Australia, you're only going to be taxed on the future profits. So therefore, everything at the time of relocation, all the profits made to that point, will be free of tax. So you don't need to be concerned about selling to protect it from a tax perspective. You can sell it at any time. If you sell it once you've arrived, it's only the tax profit above the valuation on arrival. So you can go in a timely manner, sell it at the best opportunity rather than worrying about arriving in Australia.
If I'm returning to Australia and my spouse has overseas property, what advice would you give around that?
Very similar to if it was in your name, that they're going to become taxable if they become a tax resident, which is usually the case as they're following you. They again just need to consider the impact overall. You want to consider whether or not you want to release some capital from that through either financing or through sale. You may consider on the rare occasion transferring that property into joint names or into a tax structure in Australia. That's unusual, but certainly should be considered. So they need to just consider that they're now going to be under the Australian tax regime, and they need to consider it in the fullness of that.
If I'm planning on returning to Australia, when do I need to value my property assets overseas?
The important date is the day of moving to Australia to permanently live there. So again, there's a misconception that it's the day the visa is granted or the day you start, coming down to Australia, ad hoc. The most important date is the day that your residency changes for tax purposes, and that's basically when you've packed up all your belongings, you've made the conscious decision to relocate yourself and your family and start a new life in Australia. That is the day of change of tax, and that's when valuations and other issues need to be considered, and you're taxed from that point onwards. They're very much about intent, but in all the years I've been doing this, everybody knows the day they relocate to another country. It's pretty obvious by your actions and the influences around you.
If I sell my property after I return to Australia, how is tax calculated?
Well, the good thing is past profits are not subject to tax. You would need to get a valuation as at the day of relocation. And when you sell the property, what will happen is you'll simply have the profit from the sale price to the original valuation on relocation, less any acquisition costs, selling costs, improvements that you've made along the way. That net profit above valuation only would be then subject to tax. If you've been back in Australia more than 12 months, it's likely you would get half of that profit additionally tax-free. So you'd only have to declare half of the profit in your tax return, and then you would be taxed on marginal rates in Australia. So you get some good concessions, and it's only on profits after arrival that would be subject to tax.
My property overseas has lost value. Would you recommend selling as part of my repatriation tax planning strategy?
That's a tough one, because what happens when you move to Australia is the property is deemed to be acquired at market value. So if market value is less than cost, then you've got some problems there. Even if you sold it in the future for higher than the market value but less than your actual cost, you would end up paying tax on that, because it would be an increase from the valuation, to the day of sale. So you've got a problem there. Now what it means is you need to be sure that you're confident about that profit being worthwhile. Because even though you're still losing money in physical terms, you're a profit for tax purposes, you need to make sure that your potential gain is worth it even after the tax adjusted. It really comes down to the faith you have in the asset to hold and appreciate in value. If you've got confidence in that, I genuinely would probably be inclined to keep, even if it did mean tax consequences. If you don't have confidence in its ability to grow, then you might as well sell and redirect the funds into an area that would be more beneficial to you, such as debt repayment or alternate investment that could maybe outperform it.
I've got a property overseas, but I don't plan on renting it out once I repatriate back to Australia. Do I still need to value the property? And if so, when would I need to do this?
You absolutely still need to value it. The day you stop living in it, it becomes a taxable asset. So you do need to get a valuation on the day you relocate. The fact that it's not rented doesn't have any relevance, okay? It's simply a taxable asset for capital gains tax purposes. Now, if you had lived in the property prior, it can remain capital gains tax free for up to 6 years if you don't replace it with another property. So you may have an issue that, it is taxable, but the tax rate could end up being zero from other benefits. But you certainly want to consider a valuation if you intend to keep it longer than 6 years, because it's going to move into taxable at some stage. And you can obviously do a retrospective valuation, but as time passes, that gets harder and harder and harder to do. So it's good bookkeeping and prudence to get that valuations around about the time you move to Australia or soon after.
I have overseas stocks. Can you explain the tax situation if I was to keep them or if I was to sell them?
Well, the good news with any asset, property, shares, anything, is that you're only subject to tax on future profits in Australia. So again, you don't have to be mindful that they are going to be high tax if there's high profit at the time of relocation. They would need to be valued, but if it's a listed stock, on any stock exchange around the world, it's very easy to get the price on the day of relocation, and only profits above that would be subject to tax. There will be, again, the simple question as to whether you would buy those, shares at the current price and whether you need the money for other purposes. So you do a quick evaluation of those things, but there's certainly no deterrent to keep that stock. It would benefit from the 50% capital gains tax free status once you've been in Australia more than 12 months. So if you think there's still a lot of upside to have, you don't need the money for anything else, you might as well keep it and enjoy that upside down the line.
If I'm the salary earning expat, but my family returns to Australia before I do, what are the tax implications around that? And will that affect residency?
It can do. I mean, in Australia, residency laws are not family based. All of our tax laws are based on the individual, not the family unit. So what that means is that, certainly there's a situation where one of you can move back to Australia and become a tax resident, the other can remain overseas and not be tax resident. However, what the tax office will look at is how genuine is that circumstance. And obviously it's not uncommon anymore, but it is still somewhat unusual that you would have families separated in that regard. So what they'll be looking for, particularly for the person overseas with the salary, is have you disconnected with the country you were living in and reconnected with Australia? So do you still have a residence up there? Did your employment change? How frequent is your travel? Have your belongings moved to Australia? There'll be a lot of relevant questions around how real your life is overseas. The tax office needs to be confident that you are not a fly-in, fly-out worker living in Australia and going overseas. As long as you can show that you're genuinely still in the country of source, then you won't have any issues. But make sure that that's genuine, make sure that that's honest, and where possible, make sure that as little of your circumstances have changed so that you can show that there's been no disconnection with your original country.
Should I put my assets into my spouse's name if they're not working before we return to Australia?
Well, in Australia, because you're taxed as an individual and the personal tax rates can be very, very high, you would obviously want to try and have income in a person that had a lower salary position than the other. Now, whether it's possible to transfer, you certainly want to consider, but the other thing you might want to look at is using tax structures such as family trusts or investment companies. They have sensible tax provisions that will allow you to keep the tax down to the lowest level. So rather than moving from, say, one person to the other, you might take the advantage to move to a structure at the same time to give you more flexibility in case you both became earning later on. The thing that you would consider though is obviously the cost and ease of moving those assets. Obviously something as simple as a bank account is very easy to shift into one person or the other's name. But if you had a property, for instance, selling that property from one partner to the other partner could incur stamp duty, tax in the country of the property. It could incur all sorts of issues, lending problems. So you want to give it some due consideration. If it's a simple thing, we'd usually recommend you look at a structure, but if it's complicated, then just make sure that you're planning around it and factoring it into the equation.
If I repatriate halfway through the Australian tax year, am I liable to pay tax on all earnings and payouts overseas in that tax year?
What happens in Australia is it's quite a fair system. You will only pay tax on earnings after the day of arrival. So if you've got salary or anything like that, regardless what was earned prior to arrival, that would not need to be declared. You're what's commonly referred to as a part-year resident. So for part of the year, you're non-resident, non-taxable. The other part of the year, you're taxable as a resident. You declare salary earnings. The only time that may have some issue is if you had some pensions or superannuation rollovers or cash outs. Then you want to certainly assess those on a case-by-case scenario. And certainly what you're trying to do is if you've got bonuses or things like that, you definitely want to try and get those paid to you prior to arrival. There can be some issues, particularly if you've got continuity of employment, that if you were due a bonus for the previous financial year and you had not received it prior to arrival, that can come up and be taxable under the current rules. So you want to be mindful and try and make sure you've been paid out all base entitlements prior to arriving, if that is practical. The truth is it's not always easy to determine what your boss will do, but certainly it can't hurt to ask if it's genuinely due prior.
If I'm planning on selling my Australian property, should I do so before I leave my current country or after I return?
A lot of this will depend on whether you've lived in the property prior. Under the old rules, it wouldn't have really mattered too much if you'd sold before or after. Under the new rules, which just came into effect in December 2019, if you sell a property while living overseas that you had lived in prior, you do not benefit from the tax-free portion of principal residence. So in that case, you're absolutely best to sell that property when you're living back in Australia, even if it's the day after returning. The only trick is that you have to return permanently and become a tax resident. If it was just an investment property, it would not matter whether you sold it in or out of Australia. The advantage of selling it when you're in Australia is that you will get pro rata the half tax-free portion. So certainly the longer you go back before you sell it, the more and more of it will become tax-free of that 50% portion. So there's an advantage, but again, that's assuming that you have the will to keep the property and that it's financially prudent to do so. So if you can, definitely keep it longer, but if you need the money, it's not really a big issue.
Should I consider paying off my Australian property before I repatriate?
Again, it doesn't really matter if you do it before or after. The good thing there is that we definitely want you to pay down loans, but we really only want you to pay down the loan on the house you intend to live in. So if it's an investment property, it's actually quite advantageous to leave the loan on the property. And certainly you don't want to reduce that as well as your residence. If you've got some loan left on your residence, you don't want to be reducing any investment debt. So the main thing is that we would always encourage, if possible, to reduce or clear the mortgage on your intended family home. Now, whether you do that progressively or you wait till you go back, that's again will be circumstantial. We often find the situation though that you think that you're going to live in property number one, and circumstances change and you might find you're relocated to a different state or you buy a bigger property. So the best thing is to usually wait until the last moment where you're sure that that's the property you're going to live in and pay it off then, just in case circumstances change.
So how do I calculate the value of my shares, and does the ATO have an online calculator that I can use?
Yeah, the ATO doesn't have any reference tools, but what happens is it's quite simple to find the value of shares. Most websites these days will give the historical data, so you can go and search for a certain date and find that. If you remember, one of the good things that you can do is obviously take a snapshot of your screen, with your portfolio on the day of relocation. That's nice and easy. But even if you don't do that, it's very simple to go and get it from a number of sources. If it's an unlisted share, you would need to go back to the company and see if they had a valuation there or thereabouts. And if it's a private company that you own, then you probably need to go to your accountant and ask him to give you a valuation as or about the time that you went back.
So I've returned back to Australia, but I do plan on going back to the country that I was in, or maybe to another country. What do I have to keep in mind or consider?
There's a couple of things here. If you are only going back to Australia for a temporary short stay, and we've seen that quite common at the moment with COVID-19, people have been stuck in Australia, can't travel, then that may not in fact change your residency. So you need to look and say, well, what is the actions going on? If you think you're going back for a couple of years, and if you imagine the tax office is usually considering 2 years to be the indicative amount, that's what they consider to be permanent intent. So if you were going to be in Australia for 2 or more years and then think you might go back overseas, there are issues that you need to consider, such as you'll have to have the valuation of your assets, coming into the country, and then you have to do a valuation going out, and you may be subject to tax on the difference and the growth during that period. So you certainly want to consider that if that's going to be, a potential, because you need to be aware of what that tax implication may be, because it could be a nasty surprise on the way out. Now, if that is too high, you can defer that tax by leaving the asset as taxable rather than paying on the way out. However, that often is more disadvantageous because it is open-ended. And if you end up staying overseas for a prolonged period of time, you could end up paying a lot more tax on the future growth than you would have if you had paid the tax on departure. So you really need to get some specialist advice on that, because it's a broader issue, and depending on the asset type you have, etc.
So do I need to declare to the ATO when I return home and how long I'm planning to stay in Australia?
Well, it's a nice and easy process. There's no separate form that you need to fill in. It's actually done in your tax return. So what happens in the year that you go back, there's a question in your tax return that says, did you change residency during the year? So if you either came back, or indeed if you had left, you would just put in there and say, look, I came back on such and such a date and my residency has changed, and they would calculate the pro rata period that you were there, and that may affect something like your tax-free threshold. It gets reduced, in that case, but it's a very simple process done in your tax return, and so you don't need to worry about it.
If I sell my property when I migrate to Australia, am I liable to pay tax in both countries?
What would usually happen is that Australia will grant a foreign tax credit. So they'll calculate whatever the capital gains tax is in Australia, and bear in mind you'd only pay it on profits after arrival. They will see what portion of that was tax payable overseas, and that portion that is taxable in Australia will be granted a tax credit usually for whatever tax you paid in the country of the property. So you won't tend to pay both. You'll tend to pay whichever is going to be the highest. So if the tax in the country that the property was in was lower than the Australian portion, then you'll pay the top up. But again, only for the relevant period that was in Australia. So you get a valuation, it's all quite easy. It is a little bit of a complicated calculation, but luckily we're there to help you with that, and you shouldn't have any problems.
Thank you so much, Steve, for answering those questions. Hopefully our audience has gained some valuable insight out of that. If you do have any questions, you can visit our website at www.smats.net, or alternatively, send any inquiries to smats@smats.net. Thank you.